Good morning, guys. Today we're going to be talking about risk management. What is risk? How do we look at risk, not just in trading but also in investment? Because clearly this is a top trader competition, but ultimately trading is done with the long-term focus also of investments. But before we start on me sharing some of my ideas with you, I actually want to start with a blank slate and ask you guys, what do you think is risk and how do you perceive risk, maybe in trading in particular, but also just in general? And I'm going to turn this around and actually take some notes, and then once we're through the lecture, then maybe we can revisit some of your thoughts and see if anything has changed after I've shared some things with you. So, who's got any suggestions or thoughts on risk? Yes, let's hear it.
I think that risk is uncertainty.
Okay. And how would you define that uncertainty? Is it uncertainty about the outcome?
Yeah, it's uncertain, an uncertain outcome.
So not necessarily uncertainty at the outset of something, but rather what will transpire in the future.
Yeah.
Okay, good stuff. Anyone else? Yes.
I would say risk is more or less like the unfortunate outcome.
Okay.
An unfortunate outcome, because what's the risk? What's the risk of you coming here?
Okay.
A car accident.
Okay. So you're seeing it more as sort of a one-sided thing. It's only the bad that can happen.
Yes,
so that's okay. So for you, it's about the, let's call it the downside, the bad.
Yeah.
Right. Any other thoughts?
Well, as a trader, I would say geopolitical environment.
Okay. So the extent to which it affects what happens in the stock market in particular. Okay. You also had an idea, right?
I think risk is what you have to lose, in a sense, but not in a negative sense necessarily, but it's what do you have on the plate in order to gain the reward, and what's the volatility, what's the expectations, all those elements.
Okay, so for you it is two-sided, so not just the downside, but it's also about the opportunity that risk and volatility can bring you in terms of the upside. All right. Right. Okay. Any other thoughts? Yes.
For me, I think it's a potential. The essence of understanding the potential results of taking an action.
Okay. Potential results from taking an action. Right. I like it. Any other thoughts?
I have to agree with Jason. Uncertainty. I can't think of anything else. I just want to
No, that's good. That's good. I think on my very next slide you will see how it's a very good encapsulating sort of topic or word that actually takes into account a whole lot of things. Right, so I think we've probably covered that quite well in terms of what constitutes risk in trading and investment. So I've summarized it like that for you. And if we then start and we look into trading, and I'm going to try and do this upside down. I'll use my power. Not to remain empowered. There we go. Can you still see? Are you okay like that? All right. So the one way to look at risk would be your mathematical measures that you've got. So yeah, you mentioned volatility or standard deviation. That is certainly one of the best known mathematical measures in terms of risk. And what that tells you is it gives you an idea of the extent to which something varies over time. So we can also talk about downside risk, as you quite rightly pointed out. The sort of the assumption around standard deviation or volatility is a normal distribution, and there's lots of academic literature that have proven that markets certainly are not normally distributed, and it remains one of the biggest, I think, flaws that people do in their analysis is to assume just normality and not take sufficient cognizance of what would be called the fat tail risks. So things like black swan and so on that you've heard about, those are typically your fat tail risks, and if you don't take enough cognizance on the downside in particular of the big unexpected risks, you really can come quite short. In some instances, people would even, in a mathematical sense, refer to risk as tracking error. And this is quite an important context more in the investment arena, maybe rather than in the trading environment, where mandates are specified based on a certain benchmark index. And often the amount of risk that an asset manager is allowed to take is expressed in terms of tracking error. So how far is he allowed to deviate away from the benchmark, either going overweight or underweight shares. All of these mathematical measures, the important thing about them is they are all objective. You can calculate them mathematically, quantify, and it's a number that it tells you exactly what it's all about. But that's not the only way that one can think about risk, because there's this behavioral thing also. The market is not an objective thing because it's people that trade and people that interact with the market. So from the behavioral side of things, this is exactly where that uncertainty comes in. The uncertainty about the outcome, the uncertainty about the decisions that I've made. Will it actually give me what I require? I'm not even sure that how I define what I require has been well specified. There's even uncertainty around that. What is the desired outcome? Is it a certain amount of money? Is it about doing better than someone else? Is it about the event, the geopolitical event that I envisage actually transpiring? So there's even uncertainty around uncertainty. There's fear. You know, often I think the two emotions that are best, that best encapsulates the emotions that one experiences in a trading and investment environment is greed and fear. And those are probably two of the most debilitating emotions that one can experience, and they're equally bad. The interesting thing about these behavioral aspects is these are subjective. There's no objectiveness to them. That's actually, it all depends on who you are, how you feel, are you having a good day, how much noise have you been listening to, what are the people around you saying, do you feel good about yourself or not, do you feel confident? So how does one combine the objectiveness of mathematical measures with the subjectiveness of these emotional sort of issues that come in? When you look at risk and you look at it also as not just a downside or an uncertainty, but actually a source of return, now suddenly you start thinking about risk as an opportunity, not just as a, oh, what could go wrong? So you use the example of what was my risk of coming here this morning? Oh, I could have been in a car accident. But what was the opportunity of me coming here this morning is I get to share time with you. So there is another side to risk as well. So risk is also a source of return. And there are these well-defined, what would be referred to as risk premium. So things like, for example, value. So the value style or the value metrics around stocks. So things with low PEs, for example, maybe high dividends or low price to book values or those sort of things. Those could be considered a value risk, but it also is a value opportunity, and the market is expected to give you a return premium for the fact that you're taking on that risk. The same sort of premium also applies to small caps. Typically these might be stocks that are less investigated or less studied and analysed by others, and that creates opportunity. So yes, there's risk in it because one could argue that with a small cap share, there's a bigger possibility that they might actually go out of business or that things could go wrong. So the risk is bigger, but it also means that the premium that you could potentially earn from it is higher. Another one that's quite interesting is illiquidity. Illiquidity could be considered a risk premium, although I'm going to talk to you a bit later about illiquidity again and explain to you why it's a dangerous risk premium to take on, because it's probably got as much downside risk as it's got upside risk. So we'll get back to that. So what is the reality around risk when we look at all these different sort of things? Well, the reality is that it really all comes down to just one thing, and that risk is, in this world, it's about losing money. And you definitely don't want to be losing money. You know, I think it was Warren Buffett himself who said, rule number 1 in investments, don't lose money. Yes. Rule number 2, don't forget rule number 1. So at the end of the day, that is probably the most important thing. It's about not losing money. So how do we not lose money in this business? Well, you've got to look at a margin of safety. The bigger the margin of safety that you can create for yourself in your trading and investment strategies, the better the chance that you will not lose money in that process. And ultimately, I guess for you guys, the biggest risk at the moment is elimination from Top Trader. Right, so I think if your biggest risk around here is about elimination from Top Trader, this is probably a good time to talk about the difference between absolute risk and relative risk. Because I think for most people, their view is relative risk. Life seems to be a competition. It's all about, can I run faster, jump higher, shout louder, sing better, cook better, or trade better than the next guy. And the bad news that I've got for you is that actually has very little to do with success in terms of what we are doing here. So in terms of this competition, that's all good and well. You guys just want to at least be better than everybody else. So how do you sort of, not get eaten by a cheetah? Well, you just need to be faster than the slowest guy. Then you're okay. The problem is that this is also how most people in the investment industry, unfortunately, tend to manage money. It's just about, can I be better than the next guy? And that is exactly the wrong way to think about trading and investment if you really want to be successful in it. This is what we would call a good way to actually manage your business risk. So for a fund manager or for a stockbroker, your business risk might be reduced if you can actually be better than the next guy. But the problem is that the investment risk for your client still is he lost money. So if the market falls by 40% and you only lost 30%, you feel great because you outperformed everybody else. But your client is still 30% poorer, and that's no good. And that is why absolute risk is so important. And I think if you guys want to be sure to lose this game, it's going to be about watching each other and focusing on each other. You've got a much better chance of ensuring success for yourself if you focus on your own game and focus on your own strengths and what you can do rather than try and outsmart the next guy. So this is really, absolute risk is really the only type of risk that should be acceptable within the trading and investment industry. But here's the bad news. It is impossible to trade with zero absolute risk. There's no guarantee in this game that you can't lose money. Why do I say that? Because even if the market does not move, even if the prices don't move, just because of your trading costs and because of the bid-offer spread, the double that you see there, you will lose money in absolute terms. So how do we minimize the probability that you will lose money in absolute terms? Because that's really what it's all about. So because risk is inevitable, it's going to be all about how do you manage that risk and how do you make sure that it is as small as possible. So there's a wonderful bit of conventional wisdom that says that the more risk you take in investing, the more return you will get. Or even worse, the corollary of that is, unless you take lots of risk, you can't make lots of return. Not true. Definitely not true. It's not about taking more risk in order to generate return. For many people also, the biggest danger is when time gets less, and you will find as we get closer to the end of this competition also, if you feel that you haven't sort of squeezed enough return out of the market yet, you start getting panicky and desperate, and you try and take bigger and bigger risks to try and generate more return. And it's the worst thing that you could possibly do. Because you might get lucky, but you also might get very unlucky. And that I would definitely warn against. And I want to tell you that this is the best way to do it. Because eliminating stupidity is easier than creating brilliance.
Facebook.
Sounds like a status update, hey? I'll have to put it out there. If you can just not be stupid, you've got a much better chance of survival than you do by trying to be brilliant and the best and I'm the man.
Yeah,
if you learn nothing else from today but this, and only remember this part, don't be stupid. Might come back and bite you in that tribunal bit there. So you gain more by not being stupid than trying to be smart. And why is that? Because trying to be smart, you're competing with other smart people as well. And somebody else can be smarter than you. But in the stupid game, nobody's trying to be stupid. So it's a lot easier to be the least stupid than it is to be the smartest. So it's a lot less competition at the bottom of the pile, I promise you. So Very important also to remember is how difficult it is to make back losses once you've made them. And here's a bit of math again to remind you. If something falls from 100 to 50, it's fallen by 50%. If you want to go back from 50 to 100, it's not 50%, it's 100%. So going back and making up what you've lost is a lot harder. It's like climbing back up the mountain that you've already rolled down. Downhill's easy, uphill is the hard work. So don't even lose that money. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. So, is this a game of luck or skill? So, I want to share some interesting insights with you. How do you know if something is based on luck or skill? I believe you guys went to the horse races yesterday. Yeah. So, do you think horse racing is luck or skill? What do you guys say? Both. Okay, so there's two things about it. There's the actual horse racing itself, and then there is betting on horse racing. So horse racing itself, luck or skill? I think that's pretty much more skill than luck. There might be a little bit of luck in it. There's always an element of luck in it as well, but I think it's a lot more to do with skill, it's training and so on than anything else. Betting on horse racing, you reckon that's luck or skill?
More luck.
I think it's a hell of a lot more luck than it is skill. I think you're quite right. Now, the interesting thing is, how do you determine whether something is luck or skill? Is poker luck or skill?
Skill.
And what about lottery? Is the lottery luck or skill? You guys are quite right, but maybe you don't know why you are right. The way you define whether something is luck or skill is if you can lose deliberately, it's skill. If you can plan to lose and do it, it means that you can influence the outcome. You can influence the result. And that means there must be some skill involved. In other words, in the case of poker, if you really want to, you can lose a game of poker. Yeah. That means you can influence the outcome. If you really tried, can you lose the lottery? You can't. That's not fair. But yes, the point is that you can't deliberately lose the lottery. So if you can't deliberately do something, it means you can't influence the outcome, so it's not skill, it's luck. And that is why poker is considered a game of skill, because you can actually deliberately lose, and therefore you can get good in poker. Whereas the lottery, you can't deliberately lose the lottery, and that is why that is just a game of luck. So, yes, you've got a question.
I had a friend that we were working with. Yes. This guy, he bought, he was a gambler. He was a gambler, but he was working with us. So he was he was playing the actual lottery. He would study the numbers, and he would sit with a book every day and write down new numbers and test them and see if they came out with previous numbers. The guy won about R1 million in the lotto. He quit his job that same day. Yeah.
I would call him very lucky. It's still not skill. It's still not skill.
So, but maybe...
Because look at my next question that I'm going to ask, if you look at that. Noughts and crosses. Is noughts and crosses about luck or skill?
Skill. You can deliberately lose and you can get better at it.
There's only like 3 combinations that you can play, and if you know the combinations, it's about luck of who gets called first.
Yeah. But you're absolutely right, because you can deliberately lose at noughts and crosses, so it is skill. The skill level required to win is very low. You only need to sort of be able to be sort of the equivalent of a 5-year-old, but it's still skill. Blackjack.
You can use on purpose.
I just say luck. I used to play blackjack. Luck.
Well, you know what's very interesting?
Yeah.
It's also skill, but it's a very different skill level. Because now your competition in terms of it is not just the house, the casino, but it's also the other people that are playing against you. So yes, one can deliberately lose. I mean, you just keep going, you just say hit, hit, hit until you go bust. So it's easy to lose. But so you can lose, but it also means that you can be skilled at it. And this is an important one that I want to put in here. And what you said there was very good. It was about working at being skilled. Mm-hmm. So even with the lottery, although it's still a game of luck, with all of these other things, there's a component of skill in it. And the harder you work at it, the luckier you become. It's a famous saying by Gary Player. If you work very hard, because somebody else also just recently, Andrew Cantor, made the comment to say that one is not born with gut instinct. You're not born with a gut feeling. You learn gut feeling, you get it from experience. And a trader that tells you that, so why did you buy this? Oh, no, I had a feeling, I had a gut feeling. He's either lying, he's trying to just get lucky, or if he really has a proper gut feeling, it comes from experience. So the harder you work at this game, the better you will become over time. Because trading is about being skilled. It's not about just being lucky, but you've got to work harder, because the relative skill level, relative to whom you've got to compete and relative to what you're trying to outsmart. The market is like a super casino, it's like the house usually wins, and you've got to be super skilled and very hard working to actually make that win. Right, so why is risk management more important than chasing return? Well, what I just want to start off with is just be careful of not overestimating your own skill level. It's a wonderful thing that I often see. We blame the market for all of our losses, but we take credit for all of our profits. How many of you have seen that? When I make a good trade, yes, I was so clever. When I lose, yes, we blame anybody from Ben Bernanke to Abe to Bulema to anybody. It's anybody's mistake but your own. Acknowledge your fallibility, acknowledge your shortcomings, because that's where you learn from. Don't fall into this trap of being overconfident and being over-reliant on thinking you are invincible. So what I want you to be aware of is that why I say risk is more important than return is that there are different qualities of risk, and for some of them you will be rewarded, for others you won't be rewarded. So the poor quality or the low quality risk indicators are the things that are unavoidable. These things just add volatility to your portfolio and you actually can't do anything about it. So these are many of your macroeconomic factors. You can't influence the outcome. Interest rate risk, currency risk, credit risk, even specific industry or sector risk. Things like what's going on in the construction sector, for example. These are, or even the mining sector with strikes and so on. These things add to volatility in your portfolio, but you don't necessarily get compensated for taking on this type of risk. The high quality risk are those risk premia that we were talking about. So this is where you can get compensated for taking on the risk. So when we talk about things like the value risk premium, or we talk about things like the small cap, or even momentum, these are also risks that you take on, but they have the potential for return associated with it. And I promised you that I would come back to the issue of illiquidity. The issue of illiquidity is that although it can be considered a risk premium, for me, I relate this more to, it's like flipping a coin. It could go either way. There are huge gains to be made, but there are also huge losses to be made in terms of illiquidity. The problem with illiquidity is that if liquidity dries up, so if there's fear in the market or there's a lack of liquidity, you are almost guaranteed not to be able to realize that illiquidity premium that is embedded in it. If there's a sort of a good feeling in the market and lots of exuberance and a lot of confidence, then there is the potential that you can make a big jump. But beware of trading the illiquidity premium. It represents more luck than it does skill. So, I say there, it's a gamble because it can go either way. So how do we manage risk in trading and investments? I'm going to start off with the trading side and basically say, probably the most important thing that you need to know before you even enter a trade is what's your exit strategy. Because buying the share is just the first step. You haven't made any money until you've sold the share. So when are you going to sell it? How are you going to decide to sell it? What is the motivation? Why did you go into the trade? What do you expect to happen to make you decide to get out of the trade? So have a stop loss. Stop losses are incredibly important, and that is where those objective mathematical measures come in very handily, and we're going to talk about that shortly. But have a stop loss, so know when you are not prepared, where you actually just kill the trade without any other consequences, thinking about it further. Stop loss, very important. don't be swayed by noise in the market. Once you've made your trading decision and you know why you are doing it and what you expect from it, don't get caught up by the noise of CNBC playing on screen all day long and what they're all saying and so on. That's noise. Be a very discerning listener and reader in terms of the information that is available in the market so that you're not swayed for that. Very importantly, watch your costs. I know at the moment you guys are not being charged for what you do, but that is not real life at all. Are you being trained? Then I'm so happy to hear that. Because that is real life.
Yeah.
So watch your costs.
I'm glad somebody's happy.
It's incredibly important because, even things like, I see some of you, for example, would trade into a position and then trade out of it over 2 days. You've just doubled your trading costs. Why? Why pay the broker and the JSE and everybody else double the amount of money away if you don't need to? So watch those costs. Very importantly, remain unemotional. I really do need you to sort of remain in touch with your male side, okay? This is not... So, remain unemotional. And in particular, I want to warn you that good companies sometimes make bad investments, and vice versa. Sometimes bad companies can be very good, especially trading investments. So be unemotional about why you are investing in something and why you go out of it again. You're not getting married here. It's okay. It's just a trade, okay? But when you get married, be committed. Fine. Right. In investment strategies, right. What's the best way to deal with risk? Diversification, diversification, diversification. And even in your trading strategies, I think in the tribunal, this is going to come up more than once, you've got to consider some aspects of diversification at least. Know what to expect under different market conditions. So once you've put your portfolio in place, know how it's going to react if the rand falls out of bed or if the rand strengthens, if interest rates go up or down, if US bombs Syria, if they dump gold somewhere on the market, whatever. Understand what is in your portfolio and how it will react to these events that are outside of your control. Why do you need to understand that? So that you're not surprised and therefore overreact emotionally. Because if you know what's going to happen to your portfolio if a certain macro event takes place, you're not shocked by it, you're not surprised, and you've got much better chance of actually sticking to your strategy and working through that period and seeing the other side. And as I say this, stick to your strategy. There's no one perfect strategy. You've got to find the one that works for you and then stick to it. Because the one that you have is the best one for you at any point in time. So the impact of standard deviation or volatility in terms of investment, I'm just quickly going to share this with you, why I refer to volatility as the silent killer in a portfolio. If I take two funds or two portfolios and they both have the same average return over time, but they've got different volatility levels. So the one has got a 10% volatility and the other one has got a 20% volatility. But they've got exactly the same return expectation. So you think, well, return, surely that's all that counts in the long run. No, it doesn't. This is, okay, no prizes for guessing which one is the high volatility and which one is the low volatility fund. So, by the way, if you're not strong at maths and you don't want to do volatilities or whatever, you don't have to do these things calculation-wise or mathematically. One could also look at something and get a sense of what is volatile and what not. But the interesting thing about those two different volatilities, even though the average return of these two funds are exactly the same over time, on a compound basis, the one with a low volatility actually outperforms the other one by about 30% over a 20-year period. Why is that the case? Well, it works like that. You fall down the hill by 50%, you've got to climb up that hill by 100%. It's about losses and having to make it back, and how much harder your portfolio's got to work to make back what you've lost. That's why volatility in the context of your overall portfolio is incredibly important. I'm going to talk about correlations shortly. Risk management and trading. Well, volatility should influence first and foremost the size of your stop losses. So how does volatility influence your stop loss? Well, if you've got a stock which is particularly volatile, it's no good setting your stop loss too small, because then you're going to be stopped out of the position only for it to actually bounce back beyond your stop loss again. So it's got to take into account how volatile is this particular share. So before you enter into a trade with a stock that's got a relatively high volatility, bear in mind that you must be able to stomach a bigger stop loss on that stock. So that's the first thing. The second thing would be, how many shares are you going to trade? It's not a very good idea to trade just one very high volatility share, because that margin of safety that I was talking about, the risk management, you're not going to be able to do it. So better to trade a range of ones, or at least a number of smaller trades. So how does the mathematical equation come into it? Well, you can, as I say, you could either do it technically or mathematically and do the calculations, or do a technical or a graphical assessment in terms of how volatile it is. What about correlation and concentration risk? Now, correlation is really just the sense of how different things, the co-movement of things. That's really what correlation says. It tells you something about the direction of things moving up or down simultaneously. It tells you nothing about the size of that movement. So you could have a stock that's got a relatively low volatility and a stock with a very high volatility still be very highly correlated, because they move in the same direction all the time. What you're looking for is for things that have got negative correlations to one another, because the way that the calculation also works is the combination of high standard deviation or high volatility and negative correlation actually means it reduces the risk in your portfolio, because it subtracts that high volatility from the overall impact. That's covariance. So getting a bit technical here, but just for those of you that do like to be a bit, to think about it a bit more technically, bear that in mind. And that's one of the reasons, by the way, why something like gold, often in a portfolio, can play quite a good diversification role, because it's relatively volatile on its own, but it's also got a negative correlation usually to other investments, and therefore actually gives you that diversification. But very importantly, correlations work very well under what I would call normal conditions. In times of crisis, one of the biggest problems is that correlations tend to converge. They suddenly all do exactly the same thing. So when you look at historical correlations, be sure to also look at how these things reacted under times of crisis. So October 2008 is a great time period to go back and say, let's just see how did things actually work under those crisis conditions. Another very important aspect of risk management in trading is your cash management. Warren Buffett, I keep going back to him, but Warren Buffett was also famous to say that he always keeps a very high cash component available. Now, very high in his world would be quite different than in our world, but the point being that he says if you don't have cash available, you cannot actually capitalize on opportunities when they come across your path. So if you have every single thing invested at any point in time, it means that a great opportunity might come along, but then you first have to trade out of something before you can trade into something. So once again, make cash management part of your trading strategy. Yes?
Do you think that he could have meant that more in a business sense? Because if you're invested in a liquid stock, for example, it's not that difficult to trade out of it, given it's liquid and I mean, it's almost like it's cash and cash equivalent.
Yeah. Yes, he did mean it not only in a business sense, but also in an investment sense. It's not so much that you can't trade out of that stock, but maybe you don't want to. Maybe you shouldn't have to trade out of something. Again, incurring trading costs when it's not necessary to incur those trading costs. Whereas if you have the cash available, it means you can immediately use that opportunity. So I'm not saying that half of your portfolio or too much of it should be in cash, but have an arsenal available, have some cash available to actually use opportunities as soon as you see them, and be able to capitalize on that. So another way to think about this is that you should plan for the worst rather than hope for the best. To go into an investment and say, yes, I'm just going to put that in there and I just hope it works out, that's almost a guarantee to fail. But if you go into something, and if I say plan for the worst, what I'm saying is understand and appreciate what the potential downside is. Because then you won't be shocked, you won't be surprised, you won't be distraught by when things go wrong, and you can handle it so much better. Then when things go well, it's like, hey, nice. But plan for the worst rather than hope for the best. remember, and this is my final slide, discipline, discipline, discipline. This is not a roulette game. This is not a gambling game. This really is about being prepared and taking opportunities when they arise. So I want you to consider almost like an institutional risk framework. How would an institution consider their risk management of investment and trading? First of all, define for yourself a mandate of what is your allowable range of shares or investment products or whatever. Choose the ones that you are comfortable with, the ones that you feel that you can handle, the ones that you know. Whether you define that by the size of the companies, whether you want to restrict yourself to certain industries, whether you want to restrict yourself to certain style of companies or whatever, it's up to you to decide, but do a mandate for yourself. Maybe your mandate is that you can trade in everything. That's also fine. But know what your mandate is and don't step outside of that mandate. Define what your minimum cash levels are that you're going to hold and stick to it. Don't go over that cash level. Define the capital limit that you are allowed to invest in a single trade. Don't be tempted to say, oh, this is the steal of a lifetime, this is the trade of a lifetime, I'm putting my entire portfolio into it. An institution would not be allowed to do that. It's not prudent to trade or invest in that way. Define your stop loss. And as much as you do a stop loss, also put in a profit target. There's nothing wrong with leaving something on the table for the next guy. That's counteracting the greed as much as it is counteracting the fear part. Once you've had a good run out of it, say thank you, take your profits and walk away and go on to the next trade. Yes?
Okay, in terms of having a profit target, okay, you know that you analyze your graphs.
Yes.
And you know that if sometimes when a stock breaks its support, its resistance line, it immediately becomes a support.
Yes.
So isn't it better that if you set your profit target at a support, at a resistance, when it breaks that resistance, you can make that a support and adjust your...
Yes, you can. Yes, you can. But that must be part of your strategy and part of your rule set. So define that up front. Don't make rules on the fly. Don't make rules because, oh, this looks nice now or this looks better. Define up front what are my trading rules and stick to those. That's where the discipline comes in.
And I just want to ask, is it wrong to be patient sometimes? if you say, okay, I'm going to hold the stock for such a long time and I'm planning for it to reach this target, and then it doesn't reach the target, is it wrong to be like, okay, it hasn't, then just take it out?
I wouldn't necessarily call that impatient. It depends on what the time frame is. If you sort of plan to invest in something for 3 months, to be impatient after 2 days, yes, that is impatient. But you'll see another point that I actually make right there is exactly there. Effectively manage the trade life cycle. So this is the concept of a sell-by date. Make sure that when you put a trade on, you understand what your time frame for that is. And a trade going past its sell-by date really just means that it's become stale. There might be better opportunities for you. There might be better opportunities for you elsewhere in the market. So actually closing out that trade and reinvesting the money somewhere else might be better. That's not impatient. That's about understanding the sell-by date of when that trade actually is still valid. So what I say with that is your capital may be deployed more effectively elsewhere and avoid falling in love with a trade and holding on to it against all better judgment. Exactly. Exactly. That's exactly the problem that one has. Is once you've spent so much time and energy and emotion in analyzing something, yes, you love that company, and it's like, no, she will come back to me. I know she's going to come back to me. Don't fall in love with your trades. Okay. Very importantly also, understand your assumptions that led to your trade. Understand why you went into that trade. But you're allowed to then revisit those when market conditions change or when the environment changes. If your assumption was, for example, that interest rates will remain unchanged, for example, if interest rates then change, then revisit that assumption because your assumption didn't pan out. Now you've got to rethink how you invested and what you invested. So understand what your trades were based on. And if I teach you nothing else today, it is this passing thought that I want to leave with you. Don't worry about being risk averse. I want you to be loss averse. You need to be risk seeking, because if you don't seek risk, you can't get return. But I want you to be loss averse. I want you to avoid losses at all costs. Be loss averse, not risk averse. And that's my thoughts for the day. All I can say is good luck. Oh, no. Good skill. I should have said that.